transaction 7, there is the sale of t-shirts for 80,000 on credit, and the cost of those t-shirts was 55,000. The company sells t-shirts costing 55,000. The initial inventory, the inventory is registered by 55,000, but it is going to be sold by 80,000. So there is an increase in 25,000, which is a profit. It reduces inventory by 55,000 because we are going to sell the t-shirts or the shirts or the inventory that has a value of 55,000. So the inventory is reduced by 55,000 and creates a new asset known as account receivable, which has a value of 80,000. 80,000 is the account that's going to be received in the future, because we sold the t-shirts on credit. Since the t-shirts are sold on credit, there will be another asset account that's created here, that is account receivable, and this is the money that we are going to receive in the future through our agreement with our customers. Now here's the difference of 25,000, that's 80,000 minus 55,000 is the profit of the business and would be added to the capital. So here on the top, usually we have assets, liability and owner equity. So assets should be equals to liability plus owner equity. It is a basic accounting equation. So we always have to check A is equal to L plus O. A is asset is equal to liability plus owner equity. Here we have another asset, which is account receivable. So we have cash, we have building, furniture, inventory, and finally on transaction 7 we have account receivable. That is the money that we are going to receive in the future based on the agreement with the customer. The balance of cash was 650,000 from the previous slide, and the balance after transaction 6 of the building was 500,000. The furniture is 150,000. Inventory was 430,000, and there was no account receivable on transaction 6, so it is 0. In the case of transaction 6, account payable was 200,000. This is the money that we are going to pay in the future, and this is liability account, so it is 200,000. The owner equity account is the capital, that is 1,530,000. Transaction 7, since the sale is made on credit, there is no cash involved. Cash is going to be collected in the future, so we don't have cash here. Building has not changed, furniture has not changed, but the inventory is reduced by 55,000. So after transaction 7, the inventory becomes 430,000 minus 55,000 is 375,000. And here during transaction 7, since the sale is made on credit, we expect account to be received in the future, so there is account receivable 80,000. So the balance of account receivable after transaction 7 is 80,000, because there was no account receivable before. The only account receivable we have is on transaction 7, therefore we have account receivable having a balance of 80,000 after transaction 7. So during transaction 7 we don't have liability, but there was a profit. This profit is written on the Z capital because it increases the capital of the Z company after transaction 7. Therefore, the balance of Z capital or the owner's capital after transaction 7 will be 1,555,000. 1,555,000. So the total asset of the Z company after transaction 7 is 1,755,000. That is the sum of cash plus building plus furniture plus inventory plus account receivable, and the total liability plus owner equity is 200,000. Liability plus 1,555,000, the Z capital or the owner equity, which gives us 1,755,000, and they are balanced. In transaction 8, the company paid 100,000 cash to his payables. Out of 200,000, the company is going to pay 100,000 in cash to his creditors. Cash is expected to decrease by 100,000 because we are going to pay cash of 100,000 to our creditors. And also our account payable is going to reduce by 100,000. In this transaction, the business pays cash amounting to 100,000 for a previous credit purchase. It reduced cash and account payable liability both with 100,000. So both account payable and cash will be reduced by the same amount, that is 100,000. So here the only two accounts that are affected are cash and account payable. Cash and account payable both are decreased by 100,000. So the balance of cash after transaction 7 was 650,000. Now there was a reduction of 100,000 in cash during transaction 8. Therefore, balance of cash after transaction 8 is 550,000. That is 650,000 minus 150,000. Here, in the case of account payable, during transaction 8, we have paid a cash of 100,000 to our creditors. Therefore, our account payable is reduced by 100,000. So the balance of account payable after transaction 8 will be 100,000. So the total asset is cash plus building plus furniture plus inventory plus account receivable. That has a value of 1,655,000, and the same is true for liability plus owner equity. Liability is 100,000, owner equity is 1,555,000, which gives us 1,655,000. So both are balanced. Okay, now let's go to transaction 9. The company collected cash from his receivables that amounts to 80,000. So there was a cash that's collected from the receivable or the account receivable. So this cash amounts to 80,000. So here cash is expected to increase by 80,000 because we have collected 80,000 in cash, and we expect the account receivable to decrease by 80,000. In this transaction, the business collects cash amounting to 80,000 for a previous credit sale. On the asset side, it increases cash by 80,000 and reduces the account receivable by the same amount. So our account receivable for the money that we are going to receive in the future is decreased by 80,000 because. So this will be the table. So the only accounts that are going to affect it are cash and account receivable. The other accounts remain the same. So during transaction 9, we have received 80,000 in cash from our account receivable. That is from our credit sale. So cash is increased by 80,000 during transaction 9. Therefore, the balance of cash after transaction 9 is 550,000 plus 80,000, 630,000. The other remains the same. But here, the account receivable is changed by 80,000. So we already collected all the account receivable. So the balance of account receivable after transaction 9 will be 0. There is no account receivable left. We already collected all the account receivable in cash. There is no account payable in transaction 9. There is no change in Z capital. Therefore, cash plus building plus furniture plus inventory plus account receivable gives us 1,655,000, and liability plus owner equity gives us 1,655,000, and both sides are balanced. Transaction 10, the shares costing 10,000 were stolen by someone. These shares are inventory, so we expect inventory to reduce by 10,000, and also the owner's capital or Z capital is decreased by the same amount. The loss of shares by theft reduces inventory on the asset side and capital on the equity side, both by 10,000. So both the capital of the Z company and the inventory on the asset side are decreased by the same amount. All expenses and losses reduce the owner's equity or capital. So as usual, our basic equation is assets equal to liability plus owner equity. On asset side, we have cash, building, furniture, inventory, and account receivable. Actually, account receivable went zero in the previous transaction, and in the case of liability, we have account payable and Z capital. So during transaction 10, there is no cash involved, there is no building, there is no furniture, but an inventory that amounts 10,000 is stolen by someone. Therefore, our inventory is expected to reduce by this amount, by 10,000, because it's already been stolen. It is lost. The balance of inventory after transaction 10 will be 375,000 minus 10,000, 365,000. Account receivable, we don't have account receivable on transaction 10, therefore it is zero. Account payable is not affected on transaction 10, therefore it will have the same amount, 100,000. But here, since we lost 10,000 inventory, we expect the capital of the company to reduce by 10,000. Therefore, 1,555,000 minus 10,000 gives us 1,545,000. So the total balance of the assets after transaction 10 is cash plus building plus furniture plus inventory plus account receivable. That has a value of 1,645,000, whereas the total liability plus owner equity is the sum of these two, which gives us 1,645,000, and they are balanced. So in transaction 11, we have Mr. John, or the owner, paid 50,000 cash for the telephone bill. So the payment of the telephone and the electricity bill is a business expense that reduces cash. Cash reduced, as I said, cash reduced by 50,000, and also we expect the capital to be reduced by the same amount. So the cash is reduced by 50,000 because we already paid 50,000 cash for telephone bill. So these expenses, the telephone, electricity, all the losses, the theft, so this all contributed for the reduction of the capital, the owner capital, or the capital of the company by the amount that is lost, or the amount that is been stolen, or the amount that has been paid as expense. So 50,000 is the cash that is reduced, and 50,000 is the capital that is also decreased due to the payment of 50,000 cash for the telephone bill by the owner, Mr. John. So here we have our assets reduced to 4 because we no more have account receivable. So we have cash, building, furniture, and inventory. In the liability account, we have account payable. In the owner equity account, we have Z capital. Therefore, during transaction 11, there was a payment of 50,000 in cash for telephone bill, So this affects cash and Z capital, and was reduced by the same amount, having a value of 50,000. The balance of cash after transaction 10 was 630,000. Building was this amount, inventory is this amount, account payable is this amount, Z capital is 1,545,000. In transaction 11, cash is reduced by 50,000. Therefore, 630,000 minus 50,000 gives us 650,000. And the building is the same, 500,000. Furniture remains the same, inventory remains the same, account payable remains the same, but here Z capital is decreased by 50,000. Therefore, 1,545,000 minus 50,000 gives us 1,530,000. So the total asset is cash plus building plus furniture plus inventory. That is 1,630,000. The total liability plus owner equity is 100,000 plus 1,530,000, which gives us 1,630,000. So our basic equation, assets equal to liability plus owner equity, is maintained. This is the last transaction, I think. Z company borrowed money amounting to 500,000 from Citibank for business purpose. Since the company borrowed money, so there might be account payable in the future, or we can also say bank loan. We can write it as bank loan, or we can write it as account payable equation, because both are the accounts that's going to be paid in the future. We can put it under account payable in order to make things very simple. The loan is a liability because the company will have to repay it to the Citibank. So this is account that's going to be paid in the future. This transaction increases cash by 500,000 because money is acquired by the Z company that amounts 500,000 from Citibank. So the cash of Z company is expected to increase by 500,000 on the asset side, and creates a bank loan liability of 500,000 on the equity side. So instead of bank loan, we can say it as account payable. We can write it under the account payable because both are accounts that's going to be paid, or the money that's going to be paid for our creditors. So the last table, this is our last table, which shows asset is equal to liability plus owner equity. Now our assets are cash, building, furniture and inventory. The liability is account payable, and the owner equity is the capital, or the owner capital. So balance of cash after transaction 11 was 650,000. The building was this amount, furniture, inventory, account payable and Z capital, and these are the balance of each account after transaction 11 from our previous slide. During transaction 12, there was a money that amounts 500,000 borrowed from Citibank. Therefore, cash of the company is increased by 500,000. So 650,000 plus 500,000 is 1,150,000. This is the balance of cash after transaction 12. The balance of building after transaction 12 remains the same. Balance of the furniture after transaction 12 is 150,000. This is the same. The inventory also remains the same, 365,000. But here, during transaction 12, there was a credit made by the company from Citibank. Therefore, there is a liability of 500,000. This is a bank loan, but we like to treat it under account payable for simplicity. We can create it another liability account, but the total is always the same. Therefore, we just like to treat it under account payable. Therefore, this is a bank loan which amounts 500,000. Therefore, after transaction 12, the balance of account payable is 600,000. That is 100,000 plus 500,000, 600,000. The Z company account is the same. That's 1,530,000. So at the end, the total assets after transaction 12 is cash plus building plus furniture plus inventory. That is 2,130,000, and the total liability plus owner equity is 600,000 plus 1,530,000, which is 2,130,000. So both are balanced. So these are all what we have for lesson 3. We try to see some 12 important transactions. Therefore, you have to know that first we have to differentiate which accounts are assets, which are liabilities, which accounts are owner equity, or which accounts are going to affect the asset, the liability, or the owner equity. So after differentiating the accounts, the type of accounts, you have to also differentiate which account is increasing and which one is decreasing. So in a given transaction, there should be at least 2 or more accounts that are affected, but the total asset and the total liability plus owner equity should always be the same. So that was what we have for lesson 3. Thank you very much for watching. Please like and subscribe to this channel. Our lesson 4 will be the double entry accounting system of all the transactions that we have seen in lesson 3. Once again, thank you very much, and stay tuned. Like and subscribe.